In this week's AMT Insight, I'm going to talk about China's recent crackdown on surging commodity prices. Now, the bull market in the commodity space clearly persists, and despite the shorter-term peaks and troughs and volatility, there's still this overall upwards momentum that we've seen since the onset of the pandemic. Now, in terms of the impact of that on the Chinese economy, it's generated clear inflationary pressures. You've seen producer price inflation in April rise at almost the fastest in 3 years, and a further increasing pace of growth expected in May. Now, consumer pricing inflation in comparison has been relatively subdued, and that's really because manufacturers have struggled to pass on those increased raw material costs. And that's created a problem because it's creating risks of losses, of defaults, and of delays and reductions to market orders in the supply chain. And the problem is that because the manufacturing sector has been such a strong engine of China's recovery, that regulators in China are rightly quite concerned about the potential impact of rising commodity prices on that engine of economic growth. So they've stepped in quite strictly, and in the last 2 weeks they've told producers that it's their social responsibility to contain commodity price rises, and their rhetoric has got quite fierce in terms of saying we've got a zero tolerance approach for excessive speculation, for hoarding, and for monopolies, and that's both in physical and in futures markets. Now, in terms of market participants' reactions, you can see that funds have generally pared back long positions in response to this kind of crackdown. On the Shanghai Futures Exchange, you see that aggregate open interest over the course of May dropped for aluminium, copper, nickel, all kind of evidence and symptoms of that reduction in long positioning. You've also seen efforts in China to crack down on speculative enthusiasm for commodities. So exchanges have imposed higher margins, higher fees, and there's been a restraint in putting out bullish market commentary by brokers and other market participants. So overall, outside China as well, there's been this overall risk reduction. So LME and COMEX fund positioning has moderated in terms of its length. And overall, that's had the impact of pulling prices back down from the April peaks. And particularly metals, that's evident, but particularly in the ferrous space, we've seen prices come off quite sharply from highs. Now, overall, you can see that China's had quite good success in the short term in containing the price rally and the overall bull market, but it's not something that is likely to persist, in my opinion. The problem is that the action they've taken is quite limited. It's largely verbal, and it's not really addressing the underlying drivers of why we have this big commodity bull market. And that's the easy monetary policy globally. It's the rebounding demand from places like Europe and the US now taking over from China's earlier recovery, and driven by fiscal stimulus, of course. And you've also got supply constraint. So whether that's crackdowns on emissions and electricity use by producers, whether that's a global shipping disruption and lack of container freight, or whether that's resource nationalism and strikes in places like South America and Africa. They're all things that are more fundamentally driving the rally that China has not really addressed in its recent actions. The other problem China has is it's got quite limited options for taking stricter action without compromising its other policy goals. So it's already been reducing the liquidity it's providing to its economy to deal with credit risks and potential risks with stability from that. You can see that in terms of the credit impulse and in money supply over the last few months, that's coming down gradually. And that's something that's going to be unwilling to really accelerate because it's going to risk the overall economic recovery that it's been having. Also, in terms of climate goals, China's not really going to be wanting to row back on those just to allow supply to run a bit hotter, supplies to be producing more. It's not something they're perhaps going to be willing to do. In terms of yuan appreciation, that's something that, in terms of their currency, it will help them with import costs. It will help in terms of importing commodities, but it's something that People's Bank of China have stepped in, and they've said they're going to maintain stability and try and reduce the pace of gains there as well in the yuan. So that's another area where potentially they could take action, but there's limitations and reasons why they might not want to do that because of other policy goals. Overall, China's generally just losing pricing power as well. You consider the massive engine of demand growth now in Europe and the US, driven by stimulus and easy policy. it's not something that China is in particularly in great control of, as it has been in the past, as the marginal buyer of commodities. And that's perhaps something we're going to likely to see extend, even in the long term. China has always had that kind of power because it's had these low labour costs, relatively lax restrictions in terms of environmental constraints, and that's something that's now changing, and it's going to see China perhaps losing its competitiveness as a demand driver for commodities. So the outlook really is that China's really got very few options to cap commodity prices further without derailing its own economic rebound or compromising its climate efforts and other goals. And those are things that are quite unlikely steps for it to take. It could resort to some trade barriers, perhaps incentivizing imports and exporting and disincentivizing exports of metal. That's something that maybe could help depress domestic prices a little bit, but it's unlikely to help the international global prices for commodities and for metals. So overall, I think it's worth following China's efforts. It's something that's obviously they're a big consumer and they're an important part of the market. But really, the drivers of price and the drivers of the rally of more importance are, the longevity of easing monetary policy and the extent to which big demand growth in the US and Europe can offset the slowdown that most people expect to see in Chinese demand growth. And that's going to be really the more important factor in determining sustainability of the bull market. China's options really to do that on its own independently are relatively limited.